Today, we are revisiting one of the most exciting and impactful investment strategies, the Dividend Snowball. If you've ever wondered how to build a passive income stream that could supplement or even replace your regular income, this is the video for you. By investing in dividend-paying stocks and ETFs and allowing your returns to compound over time, you can create a powerful snowball of income. But remember, the strategy requires one key ingredient, which is time. So to all of my younger viewers out there, this is your moment to shine. Pay attention, you guys. So important. And we're going to break it down 4 easy steps, and we're keeping it simple. The philosophy behind the snowball is this. The great Benjamin Graham had once said, "The true investor will do better if he forgets about the stock market and pays attention to his dividend returns and the operation results of his companies." Truer words never spoken. It's not about quick wins. It's not about timing the market. It's about building wealth steadily and consistently. Step 1, you have to start. Every snowball out there in the history of throwing snowballs at one another starts with that first handful of snow. You've got to gather it up. And for you, that means taking the first step and investing in dividend-paying companies or ETFs. Now, it's important that we take a quick moment to understand why companies pay dividends in the first place. It's not just a random act of generosity. It's actually a deliberate strategy, and here's why. Think of dividends as a company's way of saying, "Thank you for believing in us." When a business earns a profit, they may decide to distribute a portion of that profit back to their shareholders, like you. And this allows you to share in the company's success while still owning your shares. Companies that pay dividends often attract long-term investors who value consistent income. You may have heard some investors say, "I'm long Coca-Cola," meaning they are fully intending to hold their shares for life. They're in it for the long haul. These businesses know that paying dividends builds that trust, and it keeps those investors around, which helps their stock price remain stable over time. Paying dividends sends a powerful message. We're strong and we're confident about our future. By committing to regular payments, companies show that they're generating enough cash to not only reinvest in the growth of their own company, but also to reward their shareholders. When a company has more money than it needs to grow or expand, those dividends, they're a smart way to return that cash to the shareholders. Even when stock prices fluctuate, dividends provide steady income stream for investors. It makes dividend-paying stocks attractive, especially during uncertain times, because you're getting both stability and reward, right? It doesn't matter to me that the market is a sea of red. I'm still getting paid by dividends. It's pretty fantastic. So as you pick companies or ETFs, if you're so inclined, for your portfolio, consider the ones that have a history of paying and growing their dividends. We want to get a raise every year. These types of businesses are the foundation for your snowball strategy, and it's going to help you wrap up that power of compounding for the next 30 years or however long until you retire or whenever you're going to need this money. But where are you getting the money to invest? The precursor to investing is having your financial house in order. Make sure you're ready to invest. Now, you have a few options about how you want to build your portfolio. The first, lump sum investing. Now, some investors may have a small nest egg saved up, and then they decide to deploy all that capital at once, and they invest in their favorite dividend-paying stock or ETF, or sometimes both. Others engage in dollar cost averaging. Now, this is a strategy where you invest a fixed amount of money regularly, regardless of the stock's price at the time. It allows you to buy more shares when the prices are low and fewer when prices are high, effectively averaging out your cost over time. The goal is to reduce the impact of market volatility. So, for example, if you decide to invest $100 every month into a dividend-paying ETF, you're practicing dollar cost averaging. This method is especially great for investors who don't have a lump sum to invest up front, but they still want to be able to build their portfolio gradually. Now, let's say you don't have a lump sum to invest, and you aren't at a place where you can invest a fixed amount, but you can pull together some cash to invest from time to time. You can buy fractional shares. They allow you to purchase a fraction of a stock instead of a whole share. So let's say there's a stock that you want to buy, and the price is $100 per share, but you only have $20. You could still buy 1/5 of a share. Lots of brokerages offer this feature, and it makes dividend investing a little bit more accessible to everyone, even those with limited funds. So they will ensure that every dollar you invest starts working for you immediately. Now let's talk about the impact of investing and how much you can expect to earn from your dividend-paying stocks. I'm here at the Dividend Tracker, which I use to bring all my portfolios together in one. And right now, we're looking at the dividend detail for Snap-on. Now, if you don't know what Snap-on is, they are a fine maker of tools and accessories, and you may have some tools in your toolbox right at home. Now, right now, the dividend yield based on today's price of $349.47 is 2.48%. If I've squirreled away $10,000 and I can invest in shares of Snap-on with that yield, it will generate $248 in the first year. The key is to find companies or ETFs that you fully understand the business model of. Invest in quality companies that have been around for the long haul. Taking a look at Snap-on, you've got 35 years of a dividend streak. That's a long time. So we've earned $248 in that first year of investing in Snap-on. Now we've got to move on to the next step. And the question for you is to drip or not to drip. What the heck am I talking about? Well, DRIP is an acronym. It stands for Dividend Reinvestment Plan. And this is the step where you start adding more snow to your ball. Option 1, no drip. You use your dividends to invest in other companies or ETFs. And sometimes this is a good option, especially if the original company's payout ratio, which is the percentage of profits paid as dividends, is starting to creep up a little bit and is looking a little unsustainable. Sometimes the stock price is a little bit inflated, and reinvesting would cause your cost basis to go up. Or maybe you need to diversify or rebalance your portfolio. For any of those three options, you might want to turn the drip off. Option 2 is you turn on the drip. You automatically reinvest your dividends to buy more shares of the same company. So you have to ask yourself, do I prefer the simplicity of the drip, or am I comfortable being more hands-on with no drip? Now I'm going to bring you into a spreadsheet, and what we're going to do is we're going to turn on the drip. Remember, we had an initial investment of $10,000, right? The current yield was 2.48%. We'll pop that in place. Now we've got our price per share. That was $349.47. And finally, I want to go back to the dividend tracker. Look at the dividend growth rate. 11.55%. Imagine if your employer gave you an 11% raise every year. How amazing would that be? So let's pop that into that spreadsheet as well. So what just happened? Year 1 is right here. And in this row, you see my dividends earned $248. Year 2, we reinvest. And now what I reinvested bought a fractional share, because it's not enough money to buy a whole share, right? It's running for $349 right now, but it did add to my dividends in the next year. The following year, I was able to add a whole share, and now I'm up to $11,000. Now at the end of 30 years, we have a value of $269,340.64. That's our value. Look, we never invested another dime. We haven't put anything else into it. And here is our annual dividend income. So after 30 years, we invested $10,000. I'm now being paid $33,781 for my initial investment of $10,000. Isn't that freaking amazing, you guys? And there's a fun chart over time. You can see it takes a little while before liftoff. This is the plane running down the runway, and then we get lift, and the dividends are rolling, you guys. I'm telling you this because your dividends coming in buy you more shares that pay you more dividends, that increase your future dividend payouts. And this time and compounding is what creates that exponential growth that I want us all to have. But what if we don't stop at just a $10,000 investment? This, my friends, brings us to step number 3, which is invest more money. Look at your budget, you guys. See where you can make an adjustment. Can you cut back on dining out or skip the daily latte? Even small amounts like $50 here or there can add up over time. So let's stay with this notion in our spreadsheet, and let's imagine we can add $50 a month. This is $600 a year. I want you guys to watch what happens. We're going to hit enter. Ready? Now our portfolio value goes from $269,000 up to $450,000. This is another $181,000 in portfolio value from $50 a month. And your annual dividends just jumped, right? We were at $33,871, and now we're at $56,497. Isn't that amazing, you guys? This is the power of compounding. This is the exponential growth that we want. So the point is, the earlier you start and the more you add, the bigger the impact on your portfolio and your quality of life down the road, right? The final step, step number 4, optimize. This is where you fine-tune your strategy so that you're making sure that you're working towards your financial goals. Consider your timeline. If you're pursuing FIRE, that financial independence, retire early, you may want to use a brokerage account so that you have earlier access to your dividends. If you can wait, a Roth IRA offers tax advantages like tax-free growth and withdrawals. Focus on quality investments. Look for high-quality dividend stocks or ETFs that have those strong financials, that track record of consistent payments, a solid dividend growth rate. You want to get the raise every year. Get the raise. It makes a huge difference. So what are we going to do? We're going to get started. We're going to invest in dividend-paying stocks or ETFs if that's the direction you want to go in. You're going to decide, am I going to turn on the drip or am I going to keep the drip off? You're going to add wherever you can. Invest more capital whenever possible. And then you're going to optimize. You're going to tailor your strategy to your goals and your timeline. Now, it takes time. It takes consistency. It takes discipline. But looking at the spreadsheet, doesn't it make you just want to dive in right now? I love this. I play with the spreadsheet far too often. Every snowball starts small. We all have to start somewhere. So leave me a comment and I'll catch up with you next time. Be well, you guys.